time for our viewers' questions, and for that, we have Amol Joshi with us today, who will be answering your questions. And clearly, we have viewers also on the phone line who would want to connect with us. And how can you do it? You can WhatsApp us your questions on 865-797-4571. You can also email us questions on the moneyshow@etnow.tv. And now I have Amol Joshi, founder, Plan Rupee Investment, to answer all of your queries. Amol, good evening and welcome to the show. And let's begin. I will take Mr. Bhupendra's question, and he's from Mohali, Punjab. He's 39 years old, and he has two kids, a spouse, and professionally he's an engineer. And he has mentioned that he's doing 19,400 rupees SIP monthly. SIP is going on since 2017, accumulated a particular amount of corpus. And he has stopped investing in a couple of funds. I think you have all the names on you, Amol. So the funds that he stopped investing are DSP Nifty 50 equal weight, HDFC Balance Advantage, Parag Parikh Flexi Cap, SBI Small Cap. See, these are active funds. There is a particular portfolio where he stopped investing, as in he stopped his SIP, which is HSBC India Value Fund, HDFC Balance Advantage, Kotak Flexi Cap. He wants to know if he can continue in HDFC Balance Advantage Fund and Parag Parikh Flexi Cap, and is it a good idea for him to do an STP from HSBC fund to these funds respectively, and how much would he be able to accumulate if he stops investing, but if in case the amount is being compounded, if the investment stay put, what will be the compounded amount and the strategy for that? All right, so that's the question for you. We have you on the phone line just in case you want more details. I think this will be that on that part.
Good evening. Thanks for having me over on the show. I think you have read out most of the questions. Mr. Bhupender has asked us 4 questions in all. Let's go over them one by one. Bhupender's first question is whether I should make scheme changes. Now, Bhupender, you have mentioned, if you are listening, you have mentioned that you have changed schemes last month itself. So I would say, what kind of methodology or process that you follow to select the schemes or to eliminate the schemes? Irrespective of whichever methodology follow, if you have just made a decision of scheme change last month, I suggest not to change schemes today, because between last month to in last 1 month or so, no earth shaking kind of movement has happened, neither in the markets nor in the valuations nor in any other time. So I would say please continue. Also, I would like to add that your changes should have some kind of objective behind them. You have mentioned you have changed from a value to PAF to counter market volatility. So to some extent, this is certainly acceptable. Balance advantage fund benefits from the market dislocation or market volatility. But you have said we have changed from one flexi cap to another just because the duration for the given duration, let's say 3 years or 5 years, one scheme has done better than another. Now, point-to-point return is definitely should not be a single factor based on which you should make changes. It should also be dependent on what kind of your asset allocation, what is the investment style, what is your risk appetite, so on and so forth. So that's the first answer for you. Second one, you cannot do STP from one fund house scheme to another fund house scheme. So you will have to essentially make that decision. If you want to go from one scheme of one fund house to another, you will have to kind of redeem from the previous fund or existing fund. And while taking redemption decision, you have to be cognizant of the exit load as well as short-term or long-term capital gain tax that you will probably have to pay depending on the kind of gain that you have made. So please consider these aspects and then take the decision. Third point is, do I benefit from compounding only if I stay in one scheme for longer, or if I make switch from one scheme to another, will there be loss of compounding? Compounding essentially does not happen on scheme. Compounding happens on the amount that you have invested. So if you switch, by switch I mean if you change schemes because of asset allocation reasons, because of any other reasons that you follow, your compounding will not be affected. That's the third point. Last point, Bhupinder, you have asked us how much should I increase my SIP amount through step up to meet my targets. Unfortunately, you have not shared with us the kind of targets or your existing amount you have shared, but the targets are not with us. I would suggest probably you write back to us again and we will take it up during the next iteration of the show.
All right, let's move on to our next question from Han. And okay, so high risk mutual fund versus investment in shares, mid cap and small cap companies. The investment period is 5 years. So he wants, I hope he's analyzed his risk appetite or risk taking capacity over here. So, it's always ideal to have a complete equity portfolio, Amol, where you are invested, where you have exposure to direct equity and also through funds. But specifically talking about mid cap and small cap, how would you like to, place yourself in equity markets via shares, direct equity, or via mid cap and small cap funds, or you can have both. Just see that your exposure is well diversified across that category.
You have made valid points, and Rehan, I would suggest half of my answer probably is covered by Kavita just now. Having said that, let me deal with a few other points. Rehan, I would start by saying that one cannot strictly compare mutual funds with shares directly. There are multiple reasons. Let's go over a few of them. Mutual funds are managed by professional fund managers, and it's not just one fund manager. It's the fund house philosophy. It's the entire equity research team of the fund house and the entire asset management company's infrastructure that revolves around managing schemes, managing people's money. So it's managed by professional fund manager, supported by AMC infrastructure, and shares, unless you have help, shares are completely and totally managed by you or the individual based on individual own skill set. So that's point number one, which I think is very, very important. Second one, mutual fund scheme, one single scheme, even if there is an investor who invests 5,000 rupees or another investor who invests 10 lakh rupees in one scheme, that scheme, for smallest of the amount, a person investor gets diversification in one mutual fund scheme. A mutual fund scheme can have anywhere between 30 to 50, 80, maybe 100 or more than 100 stocks as well. So it's a diversified instrument. But when individual chooses to buy shares, for attaining a decent diversification, you probably have to buy at least 15, 20 stocks, if not more, depending on the kind of industry exposure that you are taking. So diversification is also very, very important. Another important point that mutual funds have that nobody else has, nor PMS, nor individual investors, is mutual funds have pass-through status. Now, what is pass-through status? Imagine that you have invested today and you redeem your funds only 5 years later. But within that period of 5 years, it's not that fund manager has not made any sell decisions. So it's possible that fund manager has purchased a share and probably 3 years later that share was sold for 80% profit. Now that 80% profit, if you were to do it, you will have to pay long-term capital gain tax on it, subject to the other terms and conditions. But fund manager doesn't have to pay because doesn't have to pay any capital gain tax because mutual fund is a pass-through vehicle. So this is a significant tax advantage that mutual fund scheme has. Ultimately, I can go on and on. There are a few more differentiating factors between a mutual fund scheme, how it's managed, and a self-managed stock portfolio managed by yourself. But suffice to say that these are 3 or 4 or 5 points that we discussed. Ultimately, you have to decide based on your comfort level, your skill set, and your past experience of managing your own portfolio.
All right, so that's a detailed answer to Rehan. And with that, unfortunately, Amol, it's time up on the show. We do have a lot of questions, but then coming ahead in the later sessions, we'll be doing that. Thank you so much as of now for being on the show and helping our viewers. On that note, it's time to sign off, but then I'm going to leave our viewers with our WhatsApp number and email ID where you can send us your question, a detailed question on our WhatsApp number and email ID, and we can get your financial portfolio query answered live by our expert. Thank you so much for watching. Goodbye.